But let's go ahead and get started. Just let you in on what we're doing here. Again, I'm Dr. Paul, and most of you guys know me. I've opened 77 offices, chiropractic offices in 20 states. Did about $100 million a year. And I have a consulting program that, number one, teaches personal injury, but the consulting is primarily to show the doctors how to have a highly profitable practice in the 4 categories of business. And then from there, take those systems and leverage it into associate doctors to create passive income and freedom. And then from there, take the residual income and turn it into real estate. And so I go into all the numbers. And by the way, that's how my net worth went over $1 million when I was 33. I was a multimillionaire at age 35. So what's unique about this is a few things. One, we're going to talk about real estate. Number 2, we're going to go into opening offices here in the Tampa area that if you want to invest in. I'll go into the investment potential with the real estate and the offices. The offices will focus on personal injury. They won't be personal injury offices per se. We'll treat everything, but it'll definitely be a marketed personal injury office. And so these are investment opportunities. And the reason that it's a large potential investment opportunity is because you can go through what's called a self-directed IRA now, where 100% of the money that's made in a retirement account is 100% tax-free as it's made and when you take it out. And there's only one type of retirement account that does that. It's called a self-directed IRA. And there's certain criteria. We'll go into the criteria, but that's the big benefit is, not just the investment potential of real estate or, an office. That alone could be worth, quite a bit if you do it right. But what really sends it over the stratosphere is when the income that's made is 100% tax-free. And that becomes now unbelievably big. So and when you do that, it does have to be what's called an arm's length transaction, meaning you can't interfere with it. And by the way, that's the way I would have it anyway. When I was opening offices and had investors, they were not allowed to. They had to be silent investors. They weren't allowed to communicate with the doctors. They weren't allowed to do anything because you can't do that. You can't have multiple bosses and multiple directions. And the good news is you don't have to expend any of your time or energy also. But when you have a self-directed IRA, it's an arm's length transaction. And so you can't interfere just because of the IRA category components of an IRA. So, but let's go into what's happening here. I'm going to talk about the real estate component first, and then I'll go into the personal injury offices, the investment potential. What kind of money are we talking about? What kind of investment? What are the risks? How's it all work? So that's really what we're talking about here. So let's go into real estate first. And now remember, this is through a self-directed IRA. But let's just cover, again, some of the basics about real estate that a lot of people don't know. I do teach the basics of real estate also. But here's the situation. 70% of the millionaires became millionaires on real estate. So that means if you do not invest in real estate, you have less than a 30% chance of having a net worth over $1 million. And, I'm real big on leveraging time and money. That's really where people get wealthy. Exchanging time for money, only 1% of the population has a net worth over $1 million exchanging time for money. In other words, you being a chiropractor, so if that's all you do, you go in and practice and that's all you do, you have 1% chance, 99% chance you're not ever going to have a net worth over $1 million. And so, the big ones is a highly profitable practice plus real estate. When you combine those two, especially when it's tax-free, it creates a lot of potential. And of course, I'm real big into passive income. When your passive income exceeds your fixed expenses, you're free. You can retire. You can do what you want. And especially when you have multiple streams of passive income. And that's what I did. I have multiple streams of passive income, exceed my fixed expenses, and that's how I was able to retire at age 33 real quick. And I still do that today. That's what I do today. So here's some basics about the real estate. Is the big thing about real estate, the reason it's so powerful. Now, remember, you have to do certain things. I mean, I tell people all the time, I said, you can buy bad gold, you can buy bad diamonds, and you can buy bad real estate. So you have to know what you're doing no matter what you do. With real estate, you're talking about the reason it's so powerful is these categories. Number one is leverage. You can put down a little bit of money to control, like an example, you could put as little down as $10,000, control a $100,000 asset. And you can't do that in any other category. If you wanted $100,000 in stocks, you have to put $100,000 down. So there's huge leverage potential, and that's what we're going to do. We're going to put down a certain amount of money to make it cash flow, but we're not going to put all the money down. We're going to have owner financing for the rest of it. And then, of course, there's the equity. Every month, the renters pay into the equity of the property. And then there's the appreciation. You always buy what's called demand real estate, and I'll talk about that in a second, or you do not buy it. And then you have depreciation. So you get a nice tax deduction, whatever the cost of the building is. Multiply that out over 27 and a half years. And that's the amount of earned income that you do not have to pay taxes on. So that gets to be a huge benefit also. And then there's the cash flow. You never want to do a property unless it cash flows. So, you have to know your ratios. That's why you always have to know real estate. That's why you always invest in your backyard, or somebody knows the demographics and the psychographics of that area. And then there's the capital gains. Now, in this particular case, it wouldn't be capital gains; it would be tax-free. So that's a huge potential. And so let me just go into some basic numbers here about what that would mean. So let's say you had a $500. Let's just say you had a house paid for and it was in your retirement account. It was only, let's say just round it off to $1,000. Okay. So you got $1,000 after taxes, maintenance, insurance, and all that. You got $1,000 tax-free. So what would that mean relative to you as a chiropractor? How much money is that? How much real money is that? Well, it's $4,000. In other words, if you were a chiropractor, you would have had to have made $4,000 in your office at a 50% overhead. Most offices have a 50% overhead to give you $2,000, and then you'd have been taxed. You'd be in a 50% tax bracket to have $1,000. So you would have had to have made $4,000 on your own to have a passive income of $1,000. Or how much money would you have had to have made to put into the bank to make $1,000? So let's say that's $12,000 a year. Let's just round it to 10 for just a second here, and say, well, how much money would you have had to have made as a chiropractor to have a passive income to invest in like mutual funds, to have a passive income of $1,000 a month? Well, let's see. If you did, let's reverse it out. The average return, the returns aren't even, obviously they're not 10%. You can't get 5% now in conservative investments. People that put their money in conservative investments right now are like 2.5% returns. So let's see, if you, what would that be? So for you to have $10,000 a year, let's just round it for easy math, and 10% return, so you'd have to have 100,000, 10%, 10 million. At let's see, 10% of $1 million would be 100,000. So what are we looking at here? I usually do the math like this. I go as an example to let's see. Let me think. Let me try to reverse out the math here and go. So you'd have to make, if you made, let's say you made $4 million a year, to have $2 million after overhead, to have $1 million, 10% of $1 million would be 100,000. 5% would be 50,000. 2.5% would be 25,000. So we're probably looking, how many are we talking about? Instead of 8 million, maybe 4 million total, have to make 4 million. Let's say 2. So if you say 2 million, and then 50% overhead gives you 1 million, 50% in tax gives you 500,000. 10% would be 50,000. 25% would be 25,000. And we're talking $1,000 a month, which is 12,000. So take a fourth of that. So we're probably talking about $1 million, roughly. You'd have to make $1 million on your own at 50% overhead to have 500,000, 50% in taxes to have 250,000 to put in the bank at a 2.5% interest rate. So that kind of gives you an idea of the amount of work and labor it takes to have a passive income. This is why 97% of the population, essentially, of the doctors can't retire on the same lifestyle at age 65. Because it's a massive amount of money you have to make after your overhead, taxes, and taxes, and then to get a return, any kind of significant return. So that's the power of real estate, is it leverages it up for you, so you don't have to make all that money. You just kind of put a little bit down toward it, and then you always make sure it cash flows, so you don't have money going into it. And then the renters essentially are paying for it, and there's cash that spits off of it, and then typically that money is put back into the principal, so it pays it off even that much faster. Okay. So that's the power of leverage of real estate. It's leverage. The second thing is demand real estate. Now we're going to focus on residential properties, and I explain this, the difference between residential and commercial, and the different types of commercial and all that, and the pros and cons. But primarily, we're going to be focusing on residential properties in what are called demand real estate areas. In other words, they're very high quality areas. Some of the categories of demand I talk about, we pay a lot of attention to low crime, good schools, good job growth, big churches. These are some of the major characteristics that people want where they want to live. And so, like I said, there's a lot of bad real estate you don't want anything to do with, because it would just be a headache. But we're only focusing on what's called demand real estate. So we look at those categories. Then we also look at the structural categories. There's certain structural categories that you do not buy also, and I explain all this in great detail in my real estate course. Matter of fact, it's coming up here. But there's certain categories of real estate that you don't buy, and so we pay a lot of attention to what's called the peak curve of consumption. What are people buying the most? Where's the highest demand with square footage, bedrooms, bathrooms, garages, space for master bedrooms. These are all, there's a whole list of items in real estate that are of higher demand versus lower demand. And of course, when you buy real estate that has the lower demand list or doesn't have the high demand, that's when you get involved with bad real estate. So you have to know the difference. So that's the structure. The finances, what we're doing with the finances, like I told you, is we're not doing any bank loans. We're not doing. I don't buy with bank loans. The two ways we buy real estate. One is from homes that are already 100% paid for. About 22% of the homes in the United States are paid for 100%. So we're going to go to our demand real estate areas, and we're going to pull the list of homes, that are paid off or have very low mortgages, but pretty much paid off. And we're going to market to those people, and then we're going to negotiate. And essentially what we're going to do is going to be the bank. So we have to negotiate with those people to get them to see. Most people don't realize this, but I can always give a seller of real estate a better deal than anything that they would get on their own for the most part if they sold their house, took the cash, and reinvested it. I can always give that seller a much better deal, and it's safe. because we secure it with the real estate. So there's insurance on the property with the co-owner listed for the balance if anything happens, like a fire or whatever. And so they're protected with that, and they're in the first position of the mortgage, so it gives them a lot of protection. And we explain this, again. You have to know how to negotiate real estate to be able to get sellers to understand and go, yeah, that makes much more sense for me to sell my home to you and get a little bit down and then do owner financing, with a % interest and a check every month. So it makes a lot more sense. So that is the other way that we buy is we buy with the notes left in place. It's called subject to investing. And essentially we put X amount of money down, and we just take over the property. So it's not leased, we own it. And we leave the note in place, the mortgage in place, and we put the property in a trust, and essentially it goes to a management company, and the management company pays on the note. And I go into great detail again on how all this works in my real estate course. But this is how I've bought real estate for 30 years. I don't go through banks. I haven't walked in a bank. I think I've only bought one piece of property 25, 30 years ago through a bank. Everything I've done was owner finance. When I learned owner financing, I always say I'm like a kid in a candy store. Once you know how to do owner financing and you have a little bit of disposable income, you can buy a lot of good stuff, especially if you know how. So it's really exciting. And that's stability. Real estate is a lot more stable than a practice. So that's the factors we look at, the finances. That's how the finances work. We always want to make sure it cash flows. So we know what the area is going to rent for. And so whatever the deal is with the payments, with the principal, interest, taxes, maintenance, and we'll include a maintenance fee and vacancy. So once the deal is done, there should be no more money going into it at all, because the cash flow ratio of the rent covers everything, including taxes, principal, taxes, maintenance, insurance. So there's always an escrow account for maintenance. There's an escrow account for vacancy. There's the management fee. So everything's built in. So if it doesn't cash flow, you don't do the deal. But it's easier to do that with people with owner financing because of the other variables. So I always go for terms. Essentially, I'll kind of give them price as long as I get terms, because the only thing I care about is terms. That's the thing that makes the deal go. How much are you going to put down and what are the terms? I just need to make sure it cash flows. So even if I pay them full price or even a little more, I don't care, because I'm not paying for it anyway. So I'd rather have the deal at overpriced that cash flows than not have the deal at all. Because remember, I'm not paying for it. And I get all the benefits. So that's how real estate, that's just a quick thing on real estate there. I'm going to do all the marketing. So I do all the marketing, marketing how I do it. So there's no cost for the marketing as of now. The management is turned over to a management company, so it's professionally managed. And that's how it works. So what essentially happens is the property is bought. It's bought, a LLC is started. The property is bought. It's put into a trust. That helps for asset protection. And then the person of beneficial interest is the LLC. And then the investors would be part owners of that LLC that is the beneficial interest to that property. So that's your legal claim to that property is through the LLC and the beneficial interest of the trust. Okay. And by the way, everything that I just said is done through the title company. and legal. It's done through lawyers and the title company and all that stuff. We make sure it's a clean title. The title company, finalizes everything. I do the initial negotiations and all that. We always have a final title company to legally put the stamp on it. Let's see. So, as an example, what kind of investment are you talking about? Well, I've bought homes for nothing before. Obviously, I don't need investors for that. But essentially, what I'm looking for is to maybe put 20 or 30% down on a piece of property. Say like $100,000-$200,000 nice piece of property. Maybe put 20% down, something like that, 15, whatever, just to make sure it cash flows. But I want to put enough money down to make sure it cash flows where there's no problem. That's kind of what we're looking at. So each property could be anywhere from $20,000 to $40,000, roughly. And when you start handing people checks, I found out with owner financing, when you start handing people down deposits of $20,000, $30,000 or $40,000, you get a lot more deals. Even though I go over how to buy properties for $2,000 or $3,000, that's a totally different market with what's called motivated. These buyers aren't necessarily motivated. They are. It's more negotiated. It's more educational sales and getting them to see that they're way better off selling their house to me and getting a decent amount of money up front and then regular checks than to sell it and go through all the selling costs, realtor costs, and all that. The average cost to sell a home is about 12%, by the way, if you don't know it. 12%. You lose 12%. And I explain how all that works in my real estate course. So immediately the seller saves 12%. They get full price for their home. And so it's not a distressed sale per se. It's really getting the owner to see, yes, it's much more advantageous to invest with me than to sell the house and take the money and put it into, a CD for 1% or 2%, because that's what a lot of these people do. And they just don't know any better. They don't know that they can do way better with their money and it be protected. They don't know it. They don't know it. So that's the marketing, the management. We talked about the marketing, the management. Obviously the goal of the property isn't necessarily that you need money now. Obviously it'd be good to put the money, any cash flow back into the principal, because it just pays it off that much quicker and creates it creates larger cash flow down the line. Remember, this is retirement money. This is retirement. This is tax-free retirement money. This is a good way to build a massive retirement through leverage. Let me go into a couple of these factors. So that's about the kind of money we're talking about. So we're talking about maybe a $200,000 home, putting anywhere from $20,000 to $40,000 down. Now, do you have to have $20,000 or $40,000? No. And by the way, here's the situation. It's a 50-50 deal. It's just a flat 50-50 deal. I do all the labor. The investor puts in the money. They do no marketing, no labor, and it's 50-50. That's what it is. 50-50 from the profits. And now, does that mean that you have to come up with, let's say that I pick up a nice home, and I need $40,000 down. Does that mean you have to come up with $40,000? And the answer is no. And that's what's one of the beautiful things about groups and the leverage of groups. So I can take 1, 2, 3, 4, 5 investors. In other words, I could take 2 investors for $20,000 each. I could take 4 investors for $10,000 each. I could take 8 investors for $5,000 each, say. And then you would just get the appropriate percentage. So 50% would go, as an example. Let's say I took 8 investors, and each investor only put in $5,000. 5 times 8 is $40,000. So The 8 investors would get 50% of the deal, 50% of everything, the equity, the depreciation, the leverage, everything. Everything is split right down the middle between me and the investors, 50-50. Now, lost my train of thought there for a second. So if there were 8 investors and they were getting 50% of the deal, then it would be that 50% would be divided equally on a percentage basis of the money that was put in. So if each person put in $5,000, they would all get the same percentage proportional of that 50%. Let's say one investor put in $20,000, and then there were 4 other investors that put in $5,000 each. Well, it would be proportional. So the one investor would get a ratio of $20,000 of the 50%, and each of the other ones would get $5,000 of the ratio of 50%. So that's the good thing, is you don't have to come up with a lot of money. You're kind of pooling a little bit. And then, of course, the big picture is leverage. So there's pooling, which makes it an easy investment. And the reason I also say that is with the self-directed IRA, and Megan will go into that in just a second, but there's a limit. You're much more limited into the amount you can put in, like $5,000 or $7,500 a year. So if you don't have one and you're just getting started, you'll be a little more limited. Now, you may be able to go back a year and start at $5,000 from last year, $5,000 this year, but you'd have to talk to Megan. Now, we use what's called a third-party administrator, and I'll tell you what, before we get to that, let me go into the out section. Anytime you do a business deal, one of the first things you have to do is go, how's this thing going to end? Who's responsible for what? So I just covered the responsibilities. So you're not, in the real estate, you're not responsible for anything. And by the way, you can't be, and it be an arm's length translation. So legally, to make it tax-free, you can't be involved. So you're not responsible for anything. You're just a financial, and then, of course, you get all the information. And then you go to what's the out section. The out is, and when you're investing, you can't just let people walk out whenever they want, because it creates a tremendous problem. As an example, let's say you got 3 investors at home, and then one person goes, well, I want out. I need my money to do something else. Well, that creates one big headache for the other 2 investors to replace that investor. And so let me just share with you how the I want out situation happens. And this is tentative right now, but I'll formalize it. But the main point is, this is not an investment where you get in and then 1, 2, or 3, or 4 years later you want out. This is not what this is about. This is about retirement funds, okay? So if you think you want your money in 2 or 3 years out of the property, then you don't even need to get started with it. So an example of how much of a problem it happens is it gets to be a real problem if somebody wants their equity out of the property. So they need to be penalized. So there needs to be a huge penalty to stop somebody from creating a big problem for the other investors. And so tentatively, I would say that the initial principle, if somebody wanted just their initial investment, not any of the equity, and nothing that's been built up in the property over years, just their initial investment, let's say it was $5,000. Then if they wanted that out within if they wanted it less than, say, 90 days, then there would be a 50% penalty. They'd only get 50% of it. So you'd lose 50% of it if you needed it fast for whatever reason. There has to be. People can't just jump in and out of these. And then if you wanted your equity out of it totally, like let's say 5 years ago, I'm going to pull all my equity out of it, not just my initial investment, but the appreciation, the equity build up and all that, and I want to move it into something else, then I'm thinking that we need at least a year to replace that investor. And there'll probably be a fine for that too. I haven't decided what that is, but I guess the point is the person that creates the problem deserves to be penalized, because it's a big problem when you have investors that want to pull all their money out of a piece of real estate and they got other investors involved. Because now you got to go and find, in other words, the money that I need to fill that void, I got to give that person a good return that was built up over time from this real estate. So they got to get a good return. And I'll just tell you, for me to get money and a good return, it takes 50%. I mean, I can do it for 30. If there was a 30%, I could still get the money, and maybe 20%, maybe 20%. But to try to find somebody just to replace your $100,000, they got to have something out of the deal, and they got to get it from the deal. So for them to get it from the deal, it's got to be from the person who's leaving, which means they got to give up something. So it will probably be something like that. And obviously this will be in total written down, but I just wanted to give you the guidelines and the understanding that pulling money out is a very bad thing if you're trying to do it quickly. And so you need to be penalized harshly. And that's why I said, if you want your original principal within 90 days, you lose 50% of it, because we got to come up with somebody to put that money in. So that means we got to give him a good deal. Then if you wanted your total equity out of it, then I'm thinking that's up to a year. So I have up to a year, and that might be like a 20% or something like that. And then, but anyway, you get the idea. But all of that everything I'm saying will be definitely finalized on paper. But you get the idea of how that works. Okay? And, okay, so I think you get the idea with that, how that works. But that'll be on paper in detail, but you get the idea. Okay, so that is that's the basics. The distributions, obviously, we probably want to we're probably going to want to put it into the property initially, just to make sure that we're stable. But the distributions would probably be like on a quarterly basis, something like that. And the reason for that is just to cut down on the paperwork, the labor and the paperwork, that probably. So if you wanted distributions, it'd probably be quarterly. And then it may even be monthly also. Monthly, again, that would be dealing with how much administrative costs there are and things like that. But that shouldn't be a problem at all with distributions. So let's see. Those are the key things, and then what I do is I will, with the investors, I will give priority to my consulting clients first, and then if I can't fill it with the consulting clients, then I'm going to give priority to my personal injury clients, present personal injury clients, and then if I can't do that, then I'll go to outside past clients or past personal injury clients. And the reason I'm doing that is the more that I've worked with you and you've worked with me, you know how we do business. And so I learn a lot more about you, about how I do business and how you do business if you're a consulting client of mine versus if I've never met you before. And so there's a huge learning curve and a lot of times a tremendous amount of miscommunication and misinformation. So the person that I want the least to deal with is somebody that I know the least about because of what I just said. And so typically people that have gone through especially my real estate course, and by the way, I recommend you go through my real estate course so you understand all the basics of all this stuff that I'm talking about. And then at least you have an understanding of how we do business. Okay. So let's bring Megan in now. This is how all this is transacted, is through above board. It's through what's called a third-party administrator. Megan represents Mountain West IRA, and it's a third-party administrator that basically does this. That's what they do by law. So Megan, if you can go in, and a couple of things I'd like for you to address, Megan, is first of all, how it would work. Let me set it up. So here's what would happen. I would find the property. The money would already be in the self-directed IRA with Mountain, with with Megan and Family's company.
Mm-hmm.
And then the check would be written from there, so the investors would not be writing a check to me. They would never do that. They would go through the third-party administrator, Mountain West IRA. Then I would request the check from Mountain West IRA to forward to the investment. So it would never go through any of my accounts, personal accounts at all. It would only be filled out to the property, and of course the property would go right into a trust, and the beneficial interest of the trust is the limited liability.
You're breaking up really bad.
Okay, and the money would go into the Mountain West. From Mountain West, it would go to the property. The property would go to a trust. The beneficial interest of the trust is the LLC, and you, the investor, you own a part of that LLC. In other, you are a part of the beneficial interest of that LLC. That's legally how it's all comes together. So let's talk with Megan now, and Megan, can you just walk through how, share with them how, if I buy a piece of property, how they as investors would move the money?
Okay, I'm going to start from the beginning. So you guys would have either 401ks, 403bs, other IRAs from other places that you're wanting to use for this investment. Once you have established which funds you want to use and either roll over or transfer, depending on the type of account, to a self-directed IRA, then you would give us a call. We'll fill out the IRA starter kit, and then you'll tell us if it's a 401k or an IRA, and we'll give you the proper form. And then once the funds are here, you'll be able to invest with Paul's group. So depending on what the documents are, if it's the private placement or directly the real estate, will depend just on the documents. And again, it's just communication with us, just following through. Is there a way I can do a screen share? I have a process diagram I want to open up.
That we can do that later. If we can just quickly give them a heads up, and then later we can do that.
Okay, so so you do the account, fund it, complete all the forms, let us know once you're ready to invest. Once you're ready to invest, you'll fill out our documents, and then all the contracts and the purchasing of the documents you will sign as read and approved. And once you sign as read and approved, then Mountain West IRA will fund the investment based off of the documents that you have provided to us from your IRA. So your IRA is actually the investor in the investment that you guys are doing together. And what that means is on the documents it'll be required that they say Mountain West IRA FBO, which stands for benefit of your IRA. So it'd be your name IRA. And we would review the documents to make sure it's all filled out properly. That's what we do, just to make sure the investment is correct within your IRA. Any expenses for the investment will come from your IRA, and any income will go directly back to your IRA. So it is all basically shuttled through the IRA. It's not going to your pocket. You're building your retirement fund. So it's just like a stock or mutual fund, except the dividend is rental income, and it's coming to your self-directed IRA.
And Megan, you're never cutting a check to me personally, are you?
No, we cut it to the investment.
Right. And Megan,
it's based off of the documents that you sign as read and approved, where we would send the check to.
And how can they trust you?
So we have a custodian, and it's Main Star Trust. They've been around for over 70 years. They're looking over all of our files as well. We are a family-owned and operated company. Our main office is based out of Boise, Idaho, And then we have a second office in Clearwater, Florida, and we've been in the business for 15 years as a family-owned and operated company, and this is all we do. And I have a whole packet that I can send Paul to send out to you guys on more information on us specifically.
And what protects them from you running off with their money?
The IRS.
Okay. In other words, you have your guidelines, and essentially that's a crime for you to do what you do. And
crimes.
And actually, you can't spend that money anyway. The investor has to sign off on where that money goes, right?
Correct. So your funds, if it is in cash, it sits in an FDIC-insured cash bank account here, earning 0% interest. So you do want to use your funds for investments. And once you have an investment, your money is secured by your choice of investment. So the cash isn't sitting here anymore, but all of your income will go right back into your FDIC-insured bank account.
Okay. And what would you say the top 3 questions people ask you that you get when you do this presentation on how to use the self-directed IRA?
Turnaround time. So the longest part will be getting funds from the account that you already have established. For a 401k or some sort of employer plan, you're looking at anywhere from 2 weeks to a month, and they normally only send checks. So you do want to make sure you get those sooner than later because we do have a 5-day check hold. And then once we have those funds here, you're ready to invest. And everything within Mountain West IRA, funding an asset, anything that we are doing for you has a 2-day turnaround. It's a 48-hour business turnaround. So as long as we have appropriate documents, we can get deals funded very quickly. It's the longest part will be getting the funds here. And what I do suggest going along with that is that you're in communication with my team as much as possible. You don't get charged for talking to us. We walk you through the whole process. Take some time, sit with us, ask your questions one-on-one if you want, or you can ask them now. But make sure you really understand the process. This is self-directed, so we'll update you and review as much as possible, but you do have some sort of responsibility to make sure you fully understand the investment and where your funds are at. So that's number 1. Number 2 is, what do I do with the money that comes back from my investments? What do I spend? What do I do with it? So the most common thing that people do with it is reinvest. So you're building a retirement account and reinvesting. The money that comes in your account can be used for any of investments for self-directed. If you choose to put that money in stocks or mutual funds, you will have an outgoing processing transfer fee of $95. So you do want to make sure that you're thinking about other investments because often you can do another investment with your funds. And then the third thing that we talk about, oh my gosh, I had this all planned out in my mind. The third thing that we get asked a lot is, oh my gosh, I can remember the doctor in the conversation that was common from your group, and I am totally pulling a blank. Oh, contributions, or what type of account is best for you. So we do offer traditional IRAs, Roth IRAs, SEPs, Simples, and individual K plans. Sometimes, because you guys are sole proprietor business owners, or some of you are sole proprietor business owners, a different type of account, like an individual K plan or a SEP, may be a better option for you to contribute more. This is all per person. If you already have a traditional IRA or a Roth IRA set up or an employer plan, if the employer plan is from an old employer, we can just transfer or roll those into an account with us. They're all self-directed. We only have self-directed accounts. Now, if you are an employer who has common law employees and you do have a 401k plan, you'll just want to contact your 401k plan provider and because you're in charge of it, and make sure that the record-keeping option is available. And you can, again, call my team and we can explain that more or help you through the process. But you can use 401k plans that currently are through your business with common law employees by adding the record-keeping option and having a record-keeping self-directed account. So you can invest if you have common law employees through self-direction. We just have to walk through it. So we do have a variety of accounts, all of which have different contribution limits. And if you have questions, call us. My team is myself, Bianca, who is based out of Florida, and then I have two in Idaho that can answer any questions, Megan Brenneman and Diana Hoff. So ask us away.
Now, Megan, the only way that can be tax-free when it builds and tax-free when it comes out is the Roth IRA, though, right?
No, so the Roth IRA is option one. The individual K plan for sole proprietor business owners does actually have a Roth option. So this is newer within the last 10 years that the Roth option has been available in K plans. So in the individual K plan, we can set up the tax-free investing method. And then if you do have an employer plan, you can open a Roth. You'll just want to make sure with your 401k provider that the Roth option is available or that they've added it to your K plan. You can open up a Roth option, and your record-keeping account can also be a Roth. So you have three different ways to make sure you have tax. You pay taxes on the seed, and you invest tax-free for the tree.
Okay, so basically if it has a Roth option, and let me just point out what she just said, is if you have an IRA account, the good thing, about the old retirement accounts is it was 100%, the money you put in was 100% tax-free. Typically, the investment, typically there were mutual funds, that was tax-free, and then typically when you took it out, it was taxed. Now, this is a different vehicle. The money you put in is taxed. So you can't have it all three ways. You can't have money going in tax-free, make money being tax-free, and take it out tax-free. There's no vehicle that does that. So generally, if the money's going in and it's not taxed, then it's going to be taxed either in or coming out. But if it's taxed going in, like the Roth IRA, so it's pre-taxed money. So they already got their money. Now the money that it makes, that is now 100% tax-free. Is that a good general statement, Megan?
Yes. Yep. So you pay taxes on the seed or the tree is another way if you like visual.
So just wanted to let you know that. So even if you have your regular type of simple IRAs and all that, where it was tax-free money going in, you still can move it into a Roth IRA, and sometimes there even might be a little fee. But if something's going to be tax-free, and again, it depends on the potential growth. You got to think of the potential growth of real estate or, investing in a business like a personal injury office, what that potential is.
And what will happen, which we'll tell you to also talk to your CPA or tax person about this. If you have a traditional IRA or 401k plan, you'll just do a conversion, and what will happen on the IRS's side, or what they would see, is that you made that money this year. So you'll get taxed on it on your current income. And you'll just add that to your current income. So we like to say to talk to your CPA or tax person because that'll obviously increase your income for the year. And there's some ways to avoid a huge income, and with their calculations, we could do half this year, half next year, whatever it works out. But make sure you talk to them about it before you convert, because the new IRS law, there is not a way to make it back to traditional. You'll pay taxes on it once you do the conversion.
Now, what I recommend is, if you're involved, is to do a partial investment. So, in other words, only have like $5,000. Start an IRA, start with $5,000, and then only invest $5,000. And so you would probably only be a partial investor, maybe a 20, 30, 40, 50, 60% investor, whatever. That way you can get going, watch the process, and it not be much of a risk, very low risk, and you can learn the process and watch how it all unfolds. And then the more confident you get in it, then the money that it spits off, like Megan said, most people just turn around and reinvest because it's tax-free money. So they just and typically you don't need the money. So typically you just turn around and reinvest the money again and do it again. And that's how it gets bigger and bigger and faster and faster. Okay, Megan, I know you got to go. I appreciate you following up. I'll let everybody know your information so they can get started with you with the paperwork if they're interested, okay?
Yes. Yep.
Okay.
And I'll send you an email with the packet that I discussed.
Okay, I'll follow up with you here shortly.
All right. Thank you, Paul. Thank you, everyone, for joining.
Now, I'm going to go into how to invest in the personal injury offices. Now, it's the same thing. The method is the same. It's a self-directed IRA, and obviously there's a lot more. There's obviously a huge potential. How much profit there is in an office, especially now. Just so the vehicle remains the same. So in other words, the investment's the same. It's the same 50/50. It's the same self-directed IRA. Everything I just talked about relative to investing in the real estate applies to the personal injury office, except the ratio of the offices. What I'm going to do now, for some of you guys that don't know, I can typically start an office for $20,000. The equipment is only $7,000. We start with a computer, chair, bare minimum. We have no leases. I do no leases. We'll start with like 2 tables, 1 therapy, 1 adjusting table, chairs, posters, file cabinet, computer, waiting room tables. That's it. And then I train the doctor. And of course the training's so important. And then what I do, there's no x-ray machine. We send out initially for the x-rays. So there's no lease, so the cost is unbelievably small to start with. And that's why I say I typically can start an office, start to finish, for only $20,000 before it breaks even and makes money. So we'll spend $7,000 on equipment, and then the rest on the rent and the labor. And then typically what I do is I start in an already built out small space. I like going to like executive suites. So we'll start in an executive suite, a space that's already built out, even if it means starting without an initial employee. And so we may have like 1 office with 1 doctor, because we could see 40 visits a week or 60 visits a week in that type of scenario, and the overhead might only be $1,500 a month, excluding the doctor. So it's unbelievably, and then what we do from there is once the doctor is profitable, then we move him. So we don't put a lot of upfront money into this. Then we move him. So it's very easy to break even. I mean, you almost break even by seeing like 8 visits a week, something like that. So, and for you guys that are chiropractors, you understand this, dollar per visit and all that. And then we move them into a 1,200 square foot office and bring in a staff member and build the business up. But the first goal is to get the business up and going and make it profitable so there's no more money going out. And that's typically about $20,000. And then what I do is I train the doctor. I do a management marketing agreement with the doctor. And the numbers are like this. Again, it's whoever the investor is, it's 50/50. It's the same thing that I talked about. It's 50/50 with the profits. The doctor in there will have several benefits, but essentially, it'll be 40/60, 60/40, depending on what he gets, depending on the volume. And so let's say that the profit will be at least 40% goes to the investors, okay? 40% of the profit. Of the 40%, that's 50/50. So 50% goes to me, 50% is divided by the totality of the percentage of investors. So if it's 1 investor that put in 20, he would get it all. If 2 investors put in 10, it'd be 25% each. You get the point. So that's what I'm doing. And I'm also looking at buying existing offices. So that may take a little more money, but obviously there's a lot more stability. But we're pretty good at taking existing offices and doing the training and doubling and tripling them in 90 days. I typically go into 3 areas. We'll double the patient retention. We'll go into active. We typically will go into the active therapies, and then we'll go into personal injury. And typically when we do those three things, the offices triple real fast. So I call those diamonds in the rough. When we find diamonds in the rough, those are tremendous opportunities. And then I always go for owner financing with the doctor that's selling it. So I like to see these old offices that are seeing like 60 visits a week, 80 visits a week, something like that, and buying them and giving the doctor a nice little down payment, enough to give him confidence to do owner financing, because we want the office to pay for the investment, the majority of the investment, not come up with cash. And then that's what I focus on. I do three things really well: patient retention, new patient, and personal injury. And when we combine those three things with active therapies, all of those are huge profit centers, and they increase the business tremendously. And of course, how much you increase it totally depends on the stats. That's why I pay so much attention to the stats and diamond in the rough type of practices. But if we start from scratch, I'm actually advertising now for doctors that will start from scratch. And so I'll train them in all of that. We'll train them in patient education, retention, marketing, personal injury documentation. And then I'm doing all the personal injury documentation. So as an example, here in the Tampa, St. Pete, Clearwater area, I'm picking one chiropractor per area. Either I'm going to put an office there, or I'm going to contract with an office there, and then I'm going to market to all the attorneys and do all the educational sales and the regular continuing legal education for the attorneys to drive the business there. And so I'll be doing all the marketing. And so anyway, that's how the personal injury office works, to give you an idea. So let me leave it like that. If you have any, I'll open it up to any questions, but here's the next steps. If you're interested, you need to get with Megan with Mountain West RA. I'll send you the information. If you want to call me directly and ask specific questions about your circumstance, and then I'm going to get with Megan and go who's involved. So who's started the application process, who's involved, how much money is available. And then whoever's there and whoever has the money available, that's the person, that's who we're going with, the people who show up and who are there. And then we'll start with real estate and the offices. I'll never make a decision without giving you all the information. So it's not like it's blind on your behalf. So I will give you all the information, just like you would get all the information on a mutual fund, okay? So it's still an arm's length transaction, but they would still inform you on everything. So before you invest in anything, such as like real estate, I will tell you everything. There's a whole checklist I'll go over. I'll go over the type of real estate it is, all the particulars that are relevant and that are important, especially the financial components. So it's not like you just blindly get involved, with investing and putting the money in with Megan and then not knowing what's going on. That is not the case at all. And then all I'll do is whoever's ready to go, whoever's at the top of the chart, I'll present all the information. I'll say, here's what we're looking at, whether it's an office or real estate. I'll present all the particulars with the people that are in order, and I'll just go from top to bottom. Do you want in or out? In or out? In or out? And I'm going to do that after I deliver all the information in particulars until I have enough money to do that deal. That's what I'm going to do. So if you're interested, follow up. I'll send out Megan's information. It's, by the way, you can Google it. It's Mountain West IRA in Clearwater, Florida. Mountain West IRA. Her name's Megan Galene, Galene. She's the one that we'll be working through. And then if you have any specific questions, you can contact me, or we'll set up a time to talk specifically. But it's all starting. The marketing is going on now. We're marketing for associate doctors. We're now starting to put in place the marketing for real estate. All that, everything is started. So whoever's on the list, that's who's going to give the offer to first, with all the particulars, until I find enough investors that I need to make that transaction go. Okay, let me leave it like that. And it took a little longer than I thought. And I guess I can open it up. If you guys have any questions, just hit your red button, and I'll entertain any questions. If not, the next step is to get get processing with Mountain West IRA, get the application processed, have your money available, and whoever's money is available, that's the first people that I'm going to be picking. I will always give, like I said, I'll always give preference to the consulting doctors first, the personal injury doctors second, and then outside investors third. If you do want to invest in real estate, though, I do recommend you do attend my real estate so you understand the basics of real estate. Otherwise, it'll be hard for you to interpret the metrics that I give you with the real estate. But we're moving forward, so I just wanted to give you that opportunity. Pretty exciting when you invest in pick good real estate that's cash flowing and it's 100% tax free. That's a check in the mail. That's a check in the mail every month, essentially the rest of your life. Personal injury office, you guys know how that works. It can go real well, it can go average, it can not do as well depending on factors. There's a lot bigger upside with the personal injury, that's for sure. There's a lot bigger income potential, but there's also a lot more variables. The real estate is pretty steady. It's like steady Eddie. The personal injury offices obviously have huge upside potential, but real unstable, until it gets going. Takes for several months, But you know how it is with associate doctors; they come and go, etc. So let me leave it like that. Sounds like nobody has questions. Follow up, and whoever. I'm just going to go with Megan. I'll be sending out emails. If you want to contact me, shoot me an email for any follow up. And then whoever's contacted Megan, that's who I'll be contacting to follow up with you. So that's if you really are interested and you want to do the next step, I would just contact Megan and get the ball rolling, and then contact me for any particulars. If you have any specific, and I can set something up one-on-one with your specific questions. Okay. All right. Let me leave it like that. Appreciate your time, and I'll send this recording out. So those are your options if you want to move forward. I'll send Megan's contact information out but you can just Google it. It's Mountain West IRA in Clearwater, Florida. Megan Galeen. And you move forward with that. That's who I'm going to be working through and with. So whoever she's dealing with, that's who I'll be talking to. Okay? All right. You guys have a great day here. Take care.